and they've been pumping this thing up. And again, if they hadn't overreacted with COVID, they wouldn't have to tighten here. I think it's going to burst this thing. By the end of this year, we're going to be in a deep downturn that's going to take a couple years to wind out. The stock market's already peaked on January 4th for the S&P, November 22nd for the NASDAQ, November 8th for the small caps. We're just seeing the first crash, which usually is 30 to 40%. You don't know that a bubble's over until you get the first crash that hits hard 30, 40%.
So I was able to interview the great Harry Dent, the author who wrote The Demographic Cliff, as well as many other books, recently on a panel with Lizette Zhang and Jason Hartman. It was a great interview. It got a little bit contentious. If you want to see the full panel interview, you can check it out down in the description below. But I asked Harry, basically, where are we headed? What's going on? What's the plan? Where are we headed? And he gave some ideas of what he sees, that in 2008, they didn't really let things fully out. So now we're headed for an even bigger crash. So he said that there is some safety in multifamily investing. It doesn't quite come through in the interview, but that's our business. So I'd love to give a plug for that, but we'll get into that later. But just why don't we start with Harry and see what he says about where we're at right now and where we're headed.
We finally saw that. So if you think, and your stockbroker is telling you, well, just sit through this and the market will always go to new highs, you will be bitterly disappointed. This is not the time. That is the best thing for investors to do most of the time, reallocate. This is not one of those times. Since they did not let the 2008 and 9 downturn play out more fully and deleverage the greatest debt bubble in history, we're going to have to do it this time. Last time, you go back 90 years on this big bubble cycle, the early 30s was the big crash, and then a lesser crash down in the late 30s and early 40s before we bottom out. So we had the smaller recession this time. We're going to have the big one on this end. I think it's somewhere in 2024, but we'll come out of this. And I think there's going to be a lot of fireworks between now and then. It's time to take advantage of this bounce, get out of stocks, get out of all risk assets, commodities, and gold too. Gold is not the sport. That's the safe haven. That's where the money runs when commodities, stocks, and even gold all go down. And any bonds with risk, corporate bonds go down a little, junk bonds a lot. This will be an everything crash like 2008, only much more. You simply got to get out of the way. Treasury bonds, I'm calculating, these are 30-year Treasury bond or a 10-30 mix, like in TLT, the easiest ETF to play, will go up 40, 50%, while everything else crashes the most in your lifetime. So I've been calling this the crash of a lifetime. I think it already started January 4th in the S&P. So this bounce is the last chance you get here, and it's probably not going to last past August, if that long. Well, again, we've been dealing with disinflation now for most of my adult lifetime. 1980 was the peak, 15, 16% inflation. Down, 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 down. Why? A generation grows up, they become more productive. Okay? We go into deflation almost naturally. We've just inflated massively to fight the COVID shock, which was stupid. It was short term in the first place. It was the wrong place for the government to panic and overprint. So again, they've been printing now ever since 2008 and 9, okay? And we've had inflation go down anyway because that's the fundamental trend. They printed, I count 10.1 trillion, half in fiscal, half in monetary, in 2 years. That's why we suddenly have 9% inflation. And that means they have to tighten. And I'm telling you right now, this tightening will not last very long. They will not keep tightening because the economy is going to retreat rapidly because it's so weak. They are under the impression now, because they've been pumping so long, oh, the economy's got strength. The economy has no strength, none on its own. This has all been money printing. And now you have to catch these money printers off guard. They'll just keep printing. Like they print exponentially more. They've lost all rationality. They'll do anything to prevent a recession. Recessions are good for the economy. Yeah, only an academic economist that never had sex or run a business would not understand that recessions basically make you more efficient, clean out the dead wood, clean out unproductive debt. You know how many unproductive debts we have now in the economy? Yeah. It's out of control. We need to flush this stuff out.
So Harry says economists who have never had sex or run a business would not understand. Quite an analogy there, right? So he's talking about where we're headed now. He talks about Japan, about where Japan has been from the 90s, how things crashed, both in real estate, stocks. He's talking about the high risk of stocks. Let's hear what he has to say about that.
It's going to make us healthier. Japan has never recovered from their early 90s and late 90s bust because they've been printing money and never allowed the debt. They kept the debt in place instead of flushing out the bad debts, which allows you to grow. So, and they have poor demographics forever. And we have a millennial generation that will pull us out of this precisely late 2024 into 2037. I said from the beginning, the baby boomers you to do it, and it's an offer now. You don't do it now, you lose it. We're going to help you because getting rid of debt is the best thing we can do. That's what recessions do, and depressions more so. And depressions only follow major financial asset bubbles. When did we see that in history before this? The Roaring 20s. That was the biggest financial asset bubble of its time back then. This is more global. This is everything. Real estate was not as bubbly. It was mostly stocks and equities. This is a bubble in everything. And gold. Guess what has bubbled more than stocks at the peak? Gold. I'm telling you, gold is going down, and then I would buy it. Because I think Asia loves gold. Gold's going to go up for the first time in history, long term after this, because it's going to be a very in-demand commodity for countries in Asia who love gold. Right now, gold will be better than stocks. You can have some of it diversification. I'm telling you, mark my word, gold will go down in the next few years. Not 80% like stocks, but 40%. My biggest warning to most people, because that's where they get hurt the most, real estate. Okay, real estate was not the big bubble in the Roaring 20s. 5-year mortgages, 50% down. Try speculating on that. Okay, this has been the time in history where real estate has bubbled more than ever, and globally, everywhere. Biggest bubble. The last crash was 34%. Real estate takes longer to go down and much longer to come back. Stocks crash more, but they come back very fast. Real estate took 5.5 years to bottom. This is going to affect. Now, here's my simple indicator. I don't care where you live, and it's going to be hugely different. It's Jason's also. If you're in Pawtucket Junction, you're not going to get hit that hard, but you will still get hit. What was your house worth? Or your office, or whatever you're looking at the bottom of the last crash around late 2011, early 2012. That is all I see us doing, but we had such a big bubble since then. That is 50% in the broad market. People don't realize that. We just go back 1 decade, and it's a 50% loss for the broad market, and people have mortgages against that, and that's where things get tricky. And I'll tell you another thing. Here's the question I always get. People say, well, Harry, if you're right, oh, I got 2 pieces of real estate. I'm going to sell the one with the big mortgage, right? No, sell the one with all the equity, with the most equity. You're pulling that money out and be able to reinvest in real estate at the lowest price of your lifetime. You sell the one with 80, 90% mortgage. Guess who's going to take the hit on that in the end? The banks. The banks are going to the government's going to have to force the banks to write this stuff down this time. And we'll see. In my entire lifetime, or even made my kids, we will not see a crash like this, especially in real estate. Real estate is the big bugaboo, more than stocks.
So you can tell Harry's not necessarily trying to make friends by this interview, right? He's got Jason Hartman on this panel, who is a real estate guy. Lizette Zhang is a metals person. You can hear Lizette. It gets a little contentious where she's jumping in and he's jumping in on her. They're kind of jumping in on each other, where Harry's saying, gold is a great investment, but not until real estate crashes over 50%. As rates go up, real estate will come down. And so he basically says the opportunity really is in waiting. And so that's really his advice to us. He's got a couple more things he wants to say before we wrap up this interview.
It's the simplest way I can say it. If you thought that was bad, think 50% worse, and then decide whether you want to sell that damn house or not. GDP's 90-ish, okay? Global financial assets are the greatest compared to GDP and the most overvalued in history, 600% GDP roughly globally. That's what has to come. All financial assets except the highest quality government and AAA corporate bonds, everything deflates. And so there is nowhere to hide. I don't have a diversified portfolio because there's nowhere to go except the treasury bonds. And then I'll buy gold. Then I'll buy gold. Then I'll buy financial assets. Gold went down in 2008, and it did, so don't say it won't. It waited at first. It looked like a safe haven. When the crap hits the fan, gold was down, just not as much as stocks. So I think gold, and I'm forecasting gold will go to 950 to 1,050. That's going to be a lot worse than a lot better. I don't care what you say. That's the only damn thing that went up when the thing got bad, including gold went down running for mommy right there in the second half of 2000. That's what it's for. It's just for the next couple of years max. And then you get out of it back into gold and commodities and stocks and real equity assets. People buy less of everything in a downturn. I'm only against gold and the crash. After the crash, I'd be happy to buy gold. I think it'll be the best commodity long-term because Asians love gold more than anybody.
So Harry says that the crash has already started, right? Stocks have come down 34%. He really believes that treasuries are the safe haven, right? That as the markets of the world start to crash, people run toward the dollar. We've seen some of that. But he says the ticker TLT is a great place to be because this is how you can invest indirectly in treasuries or in the equivalent of treasuries. But anyway, Harry's got a lot of opinions about it. One thing that he did acknowledge in this, and it didn't really come through on the video, but with Jason Hartman said, hey, what about multifamily investing? And he said, yes, that would be a good place to hedge against inflation, against a crash, against different sources of things that could negatively be happening. So that's our business. My name is Bronson Hill. I have Bronson Equity, over $200 million in multifamily assets. We have investors just like you who passively invest to join our investment club, and we're able to do these amazing deals together. And people receive mailbox money, which is money that shows up without having to deal with tenants. So you can check that out at bronsonequity.com. But I'd love to know from you in this video, did you agree with Harry? Do you agree with what he said? Do you think we're in the crash? Do you think it's coming? Or do you think it's just Harry likes to talk about the crash often, even before the crash has happened or a little bit preemptively? So stick that in the comments. We try to do a lot of educational content like this, so hopefully we'll look forward to seeing you on an upcoming video.